Thanks for tuning into Talking Point. I'm your host, Niraj Shah. There are companies which are talking about a post COVID world with a bit of fear and skepticism. And then there are companies, long established ones, which are seeing everything in a post COVID world as also a bit of an opportunity, as much as it is their social responsibility to ensure the betterment of their employees and the environment around them. Welcome to the conversation with Marico. They're doing a lot of things, they are innovating, and the post-COVID world, to my mind, will look starkly different from a pre-COVID world. So it'll be very interesting to understand from Saugata Gupta about how does he see the post-COVID world and Marico within it. Welcome to the show, Saugata. Thanks so much for joining in. Can you tell us your thoughts on how do you see the post-COVID world differently from the pre-COVID world, and how would Marico fit in that in those scheme of things?
Yeah. So I think over the last 5 months has been extremely challenging yet interesting. And I keep on saying that for a lot of us, what you have learned in the last maybe 10, 15 years, you had a learning in the last 5 months in a compressed kind of a place. And I think there are three, four significant changes. Some are permanent resets, some will not be permanent reset, but certainly a half reset. I see three, four areas where I think there is a significant reset. First, I think with respect to consumption, some of the categories there would definitely be a significant reset in consumption, whether it's in health and hygiene habits, whether it's food, whether it's immunity, and the approach to health and immunity and things like eating at home. I believe there will be a significant shift going forward. The second thing is shopping habits and digital adoption of consumers. Clearly, that has got accelerated. We have also seen, interestingly, the return of the kirana for a lot of top up as opposed to the organized retail. The thirdly, I think I see a significant change in the go-to market, and of course, lastly, I think the ways of working, and that has impacted all industries. But I think the way, as you know, in our metros, the lot of people today used to take 2 3 hours in commuting. A lot of time was wasted in commuting and in physical meetings. And I think the way, a new way of working, which COVID has forced us to do, a lot of this will remain permanently, in terms of a new operating model that will enable better productivity, better ways of working, flexi ways of working, increase diversity in the workforce. I think the biggest learning of all these things is that if you have trusted brands, if you provide value to the consumer, and of course, if you take care of people, you are more likely to, get past this challenging times. Of course, our sector is that way in terms of the impact is lower. There are certain sectors which are got impacted significantly by the COVID, but within that, any sector, the strong will get stronger and the weak will get weaker.
Yeah, well, it's a couple of very interesting points which I'll take up later on. The diversity of workforce point that you pointed out was sounded interesting, and I'll talk a bit about that a bit later on. But since you mentioned that the strong will get stronger and the weak will get weaker, that was going to be my next question. Are you going out to the market and trying to gain market share? And do you believe that in this post-recovery world, the nature of the recovery will be this new alphabet that is K, wherein the strong will get stronger and the weak will get weaker, as opposed to an L or a U-shaped recovery for your sector?
So I think in the categories where you have a lot of small players, and as I said, that consumers are wanting trusted brands. At the same time, there is going to be a challenge on disposable income, and I think this will continue for some time in terms of the people having less disposable income. They will be a little bit challenged. So therefore, it is very, very critical to ensure that you downtrade within a brand as opposed to downtrade outside the brand or outside your own portfolio. So therefore, value becomes is value giving value to the consumers and ensuring all cost advantages gets passed on to the consumer. I think is very, very critical. Secondly, companies with direct distribution, and especially in rural, because rural is one which is far less impacted than urban, are more likely to get less impacted because it will be a source of competitive advantage, because we see wholesale as a channel is something which has got impacted. And therefore, when you are a number one player, it is very, very critical that you ensure availability, you ensure value, and the fact that you have trusted brands and continue to invest behind distribution to get a significant upping in market share. And I believe that opportunity is there, because even if the category growths are subdued, there is opportunity to drive volume growth through market share gains.
Interesting. So, therefore, Saugata, I'm presuming that you are saying that over a period of time you will attempt to, whether you get or no is a separate point, and I'm guessing that you would, but you will attempt to gain market share and make further inroads in places where you are already a dominant force.
Yeah, I think in both the categories where we play, coconut oil, value added hair oil, and some other categories, there is opportunity for market share. And as I said, that is critical if we can get distribution, execution, availability, as well as getting the pricing right. Because I think that is one which is going to be critical. And therefore, if you have to sacrifice a little bit in terms of margins or ensure all costs are redeployed towards pricing, I think it's very, very important.
Very interesting. Actually, very interesting point. But just following up on that, Saugata, the widespread belief, at least in the middle of May, was, and not necessarily for staples, but for all things consumer, was that because of the growth slowdown, because of job losses, etc., consumers will largely downtrade. Now, whether the value-added hair oil segment in the April to June quarter saw the premium and the mid-range not doing as well because of downtrading or because of there not being stock, or a combination of both, separate. But do you reckon that for the next 9 months, arguably for the next 6, 7, 8 quarters, could downtrading play sport in premium categories across?
So I think there are two ways of looking at it. At the mass end, obviously there will be a kind of a secular downtrading that will happen. And as I said, it is very, very critical that if you play across all price points, you will be able to ensure that the consumers downtrade within your portfolio of brands. Secondly, the premium end of the market, and primarily that is being driven now increasingly by e-commerce. Uh, People will continue to consume some of the discretionary categories or within that. But what is going to happen is, in a lot of categories where a significant amount of growth came through premiumization, that growth was definitely going to slow down in the next couple of quarters. So therefore, if you have play in all the in all across the price points spectrum of the any category, I think it makes sense to actually ensure that you have pricing as an important lever to drive that bottom of pyramid or the bottom of this one growth. And you continue to innovate, but innovate only in the digital space to drive the top end growth. But the premiumization, that was a big driver, and I think even organized retail was driving some of the categories. That I believe, especially in discretionary part of the business, that part will certainly be a little slow.
Interesting. Well, you're telling some fantastic, or you're making some very good forecasts. It'll be very interesting to see how the industry evolves now. So since you mentioned about innovation being in the digital space, Saugata, let me ask you, a lot of FMCG players, I mean, paint companies into the hand sanitizers, or Marico, for example, into this liquid which helps, the fruits and vegetables washing, etc. So people have announced newer business initiatives. What is this? Is this an attempt to expand into categories which are looking obvious in nature and can become big, or is it an attempt to diversify the revenue base, because you yourself may not have a complete handle on what the impact on certain established categories might be? So if you have a broader range, it might help cushion the blow if there is one.
So let me talk about our approach. I think
Sure.
firstly, 89 to 90% of our portfolio are daily consumption items which are not really impacted. Having said that, over the last 3-4 years, we have been pushing premiumization in hair nourishment, in skincare, and male grooming. And that is something which had got impacted. Uh, I think so. Therefore, we picked up two categories. One is health and hygiene and foods. And in foods, obviously, we had been growing at a certain pace. And we believe this is a unique opportunity to fast track our food agenda. We were in the Saffola food space, we were tracking around 200 crores last year. And we believe that we must move that to 300 crore plus. and move it to a 500 crores, aspire to hit 500 crores. Even if we hit 450, we are fine over the next 2 year period. And because we see two trends, one is trend in people wanting healthier option. People are eating much more at home. And of course, there is also a space in the immunity, which we have launched through honey, and we are going to make a couple of launches this year. And I believe that Saffola is a strong brand, and therefore there are enough opportunities for Saffola is go to into large critic tailwind categories where there is single player and there's market share to be had. Okay. Now coming to health and hygiene, I think it's a mixture of a lot of players have entered tactically, and I believe as COVID situation stabilizes, brands which have entered tactically, which don't have differentiation, those who don't have large equity in health and hygiene, are not going to survive. Having said that, within health and hygiene, we are looking at spaces where we can have a differentiated play. VeggieClean is one. We are looking at also disinfectant sprays which we have launched. Having said that, in that hand sanitizer, I think there are 250 players, and not many is going to sustainably survive when things normalize. Having said that, I think some brands with differentiated play or stronger equity are more likely to survive than others.
Are you looking to do more, Shagata? I wonder if the post-COVID world is throwing up more opportunities and you might be tempted to do more diversification.
So I think we have enough on our plate, and I think it's important that by launching 40, 50 initiatives that leads to fragmentation of both resources and management bandwidth. I think we are clear that in health and hygiene and in foods, if we can deliver 400 plus crores of business this year, and then of course in health and hygiene, it is very, very critical that we have differentiated play. I think we have enough on our plate, and I think, as I said, that our core, there is enough opportunity to disproportionately grow, especially in market share. I would not like to, other than these two categories, enter into multiple categories. In fact, the other thing which we are doing as an organization is simplify the business. There's a hidden cost of complexity, especially in these times. And in fact, we have undertaken a significant SKU rationalization so that our operating model and supply chain are far less stressed than what it was because during the lockdown.
Is there a possibility of you giving some idea of this hidden cost of complexity? It's a great management learning, right? So, anything that you can think of at the top of the hat?
So I think if you look at when we started post the lockdown, obviously we operated with much minimum number of staff in the factories, and therefore we realized that it's important to run only significant large SKUs, ensure that we don't because there are cycle times and changeovers. Also, it has issues on when you have a large number of SKUs. There's always a long tail of SKUs, leads to lower forecasting accuracy, lower fill rates, higher write-offs, higher working capital, and I think there is a significant cost to that. And given the fact that even now the situation is not necessarily normal, because people are, in terms of supply chain and distribution, I would say it's still 80 to 90% normal. It makes sense to simplify that.
Okay. The other question, and kind of part related to this, I wonder if you believe that you have also moved to a new normal in terms of costs, because a lot of CEOs that I spoke to said that, irrespective of the moves that were taken in order to combat the COVID working environment, they were able to see a lot of things by virtue of being forced to take a step back and relook at things. So do you reckon that you have moved to a new normal in terms of costs as well?
So we started that exercise. I think we started this exercise by saying there are no holy cows. The three areas we said we must protect: one is investment behind innovation, investment behind capability, people or leadership capability development, and we said no job cuts and protection of salaries, and everything else is up for grabs. And I think what COVID forced us, and I think a simple thing, like as I talked about earlier, the thing cost on traveling, cost of running, a huge number of tail SKUs, a lot of investment behind in the, like for example, because of social distancing, you don't have extensive merchandising or extensive promoters in organized retail or beauty advisors. So a lot of things I think we questioned. And I think what we intend to do is some are efficient, some are not efficient costs. And therefore, there will be a permanent reset. Even operating models in terms of travel, in terms of working, I would think as we return to normal, we'll move into a hybrid mode of working where certain roles will be work from home, certain roles will be flexi in terms of a combination of work from home plus working from office. And that will also release a lot of space, a lot of time, productivity. So I see a significant reset. And just to give you a number, across the organization we are targeting a kind of a 150 crores cost savings this year, out of which we are ensuring that a majority, significant majority of that is a structural cost saving which shouldn't creep back when things normalize.
Wow. And this is without having or having had cut staff costs in any fashion whatsoever.
Yeah.
I mean, great. Yeah, all the best for that. Hopefully it's more structural than cyclical in nature. Saugata, a couple of things, and I'm taking a leaf out of your first answer wherein you briefly mentioned about how Kirana is showing a bit of a comeback, etc., etc. But we've had over the weekend the much spoken about Reliance Future Retail deal happening too. Now, my question is this: modern retail, large organized behemoths, now at the other end of the bargaining table, does it in any fashion, if not worry you, make you believe that the negotiations will not be as powerful for this side, which is the FMCG companies in general, as they used to be?
So I think the way we look at it is, I think modern retail in India and India FMCG sector, I mean, leave aside this year, is in a growth phase. And therefore, unlike in a saturated market where the discussion and a conversation is only on margins, I think there's a combination of things, that how do you partner modern retail in growing categories. A lot of categories are low penetration and therefore they can play a market maker. There's a question of supply chain. For example, company A with 90% fill rate and company B with 97% fill rate, it doesn't matter what the margin is. So I think it's a combination of different things in terms of partnerships. And therefore, as long as you sell a differentiated assortment, as long as you aid in category growth, I think it is going to be a win-win for both. And I think in India is a unique situation where all the channels, whether it's e-com, modern trade, or kirana, I think will coexist. It's not a question of it's an or. And therefore, our approach as an organization, it's an and approach where we say that there is a role for modern trade, there's a role for e-com, and there's a role for kirana.
Interesting. Okay, two more follow-ups to this, just to understand how you think. A lot of retail thinkers, people who look at the industry, believe that, and not just right now, but have believed for the last maybe 24 months going into, that the middleman, the role of the middleman, the commission of the middleman, and that whole chain of middlemen will slowly become narrower, in some parts even vanish, and the spoils could be taken by either side, but this will certainly narrow or go away. Would you believe that to be the case?
So I see two changes that are going to happen. I think companies see, India is a vast country and therefore direct distribution is here to stay and it will be a source of competitive advantage. Wholesale as a channel, yes, I think will slowly reduce its significance. The second change I think is going to happen is in the traditional urban go-to market. If you look at the traditional urban distribution system, which is they used to take orders, which is they used to fulfill orders, and they used to also take working capital because they used to stock on behalf of the organized for the FMCG players, and also they take market credit. I think what is happening, and this is something would have happened in 3-4 years in a COVID environment. A lot of experiments have done. I see this role changing where I think distributors, especially in the big metros, they could be essentially be almost on zero stock, where fulfillment is done by supply chain logistics players who are much more professional players as opposed to fragmented distributors. They only take the market credit, working capital goes down. We are now taking orders in telecalling, so a lot of costs we are taking away. So I see consolidation happening and a far more automation in that space happening. So I see both these changes happening, and as I said, that uh, as you know, the urban traditional go-to market was under stress because of the growth of e-commerce and modern trade. I think the rise of the kirana with and plus the automation here, what will happen is we will might have a far more viable urban traditional go-to market model that is going to evolve from now.
Yeah, I was actually going to ask you, and just a couple of very quick follow-ups as well out here, and both in favor of the FMCG players. One is that COVID taught people who are not even online orderers to go out and use this channel and use it effectively. Now, would you reckon that for large companies as well, it might be advantageous to have this become even stronger, wherein uh, customers in select products can actually order directly from the company? Do you think that's a possibility at all, which can become very large over time?
So it depends on the category. For example, in a case like suppose hypothetically Saffola, or in the case of a category like a diaper or a cartridge, which are regular use thing, you can get into a subscription model, because a DTC, direct to consumer model, or a brand.com works under two things. One, it has to have a certain selling price. At least, I mean, globally, it makes profitable only to have a selling price of $7-8 to cover all the costs. Secondly, it could be for niche brands, because
Mm,
what has taught us is that a lot of entrepreneur driven brands have grown digitally. I think FMCG large players can actually learn from there. I think a case in point is our Beardo. A significant portion of our sales comes from direct to consumer or a
yeah.
brand.com, and therefore those learnings can be actually translated into some of our premium niches. But in case of mass large players which are low unit price, I don't think DTC is a viable model.
Okay, great. One last question on this, Shogata. I don't want to make it a fully retail versus FMCG conversation, and it's not versus really, as you said, it's coexist. But one more thing that somebody told me was that for strong brands, uh, one, the bargaining power with the retailers is one thing, but two, organized retail might actually help in a faster and a higher asset turnover, and therefore, even if there is a bit of a given on the commission or what have you, it might still benefit the brand owner quite materially. Is there some merit to this argument?
So I believe that if you are number one and number two, you are least likely to get impacted. In
Got it.
any category, if you are a number three and a number four, obviously, I think with this organized retail growing, I think those brands are likely to get impacted, because at the end of the day, ultimately, they are interested in offtake and not just margin, because offtake is very critical, and therefore the kind of velocity of offtake is much more critical than the kind of margins you give over the long term.
Got it. Okay, we're talking a lot about domestic market. Your international market has looked a lot more resilient compared to peers, and I'm not really saying that you are battling against your peers. When I'm just asking you that your international business looked a lot more resilient to people at least who look at your company. Any thoughts on how do the next few months, quarters shape up, and what are you doing which is might be different, if at all?
So I think as far as international market is concerned, we are now far more focused in South Asia and Southeast Asia, maybe also Middle East, but not so much in Africa. Fortunately for us, a significant portion of our business, almost 80 to 90%, comes from countries which continues to enjoy good GDP growth, and also in terms of foreign exchange volatility is less, and that is, I think, important, because currency risk is also a big factor in international business. We will continue to we believe that we now want to continue to focus on getting full potential in these markets rather than expanding into markets like Africa or Latam, and therefore we are fairly confident of getting growth, constant currency growth in these markets even during the next couple of quarters.
Okay, Shagada, one final question. I read in one of the reports wherein you went out and said that you were trying to leverage technology for growth in the long term. You briefly alluded to some of the things, but if I can ask you for a bit of a complete lowdown on what is it that you are doing to leverage technology to help aid growth, profitability, margins, etc. And part two of my question, you mentioned briefly ahead that technology will allow you to have diversity in workforce. Can you talk a bit about that?
So I think, okay, let me first talk about technology and the business operations. I think there's a significant role in analytics, for example, whether it's in spend effectiveness and things like market mix modeling, net revenue management. There is huge scope for digital in terms of what I call consumer engagement. A lot of today consumer engagement, including research, we are using digital. So therefore, there's a role in technology, even in risk, as simple as the fact that today we have COVID, which has led to our inability to travel. A lot of risk management analytics, which happens for especially international markets, where your levels of control otherwise could be low in the absence of physical audit. I think is the analytics has a huge role to play, and therefore we are investing in analytics in the organization in a big way. Now, coming to diversity, what I talked about is, I think we lose a lot of people in the workforce, especially women who don't want a flexi way of working. I think there was a certain notion that you need to be physically present in office, whether it's 9 to 5. There are a lot of other people today's world who don't want to get locked into a 9 to 5 or a 9 to 7 mechanism 5 days a week. What I think COVID time has shown is that you can, with the technology and work, you can actually have a arrangement which is a blended work arrangement, which could be permanent with work from home. And therefore, people who choose to have flexible work timings, who don't want to work, 60 hours, 70 hours a week, which is a lot of people who want to do that. I think we have them in the workforce, and therefore there's a lot of diversity in terms of different kinds of people, and especially in some of the consumer facing area or in the new areas like digital. These kind of people actually will enrich your quality of capability. And actually, it's not just diversity in gender, diversity of thought. And I believe this, the fact that now it is well established that you can have a hybrid model of working, that will enable you to actually tap into this people.
Okay. And viewers, remember, I mean, we are out of time, but we haven't even got to talking about home cooking, which I think Marico believes is a big tailwind and a big category that could become as well. So, but of course, we can only talk about as much. But Saugata, this was very interesting. Thank you so much for taking the time out and speaking to us about a variety of things under the Marico fold and the industry. Appreciate your time and stay safe.
Yeah, thank you so much. Bye-bye.
The pleasure is ours. Thank you. And viewers, thank you so much for tuning into this broadcast. I mean, diversity of workforce, the fact that he spoke about how if all costs were directed back to pricing, I mean, it's a bit of a new thinking that I have seen, and the fact that he believes that premiumization might actually take a back seat. So all of these pretty good learning points. Thanks so much for tuning in to Talking Point today.